Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, Global Strategist at Yuanta Securities. Mr. Yu, good afternoon. Thanks for coming on today.
Good afternoon. Thanks for having me.
Well, let's start with some of the big picture things like signs the global supply chain crisis could be getting worse. The pandemic has hit production. At the same time, this suppressed demand is coming back in a big way. There are reports of shortages of some daily necessities in some countries, and there's talk about all this pushing prices up more in a form of stagflation. So it's a complicated situation. What do you make of it, Mr. Yu?
Yes, if you look at the overall energy prices rise, definitely there have been a concern about the stagflation. Stagflation meaning that the economic growth rate slows down while the recession is happening, and in the meantime, the prices for consumers are rising rapidly due to the lack of the flows. Clearly, if you look at the energy prices, quite a bit of people have been moving away from the coal-related energies to renewable energies. But recently, there's been lack of the power storages for the wind power, and that has resulted into the quite spike in the natural gas and the petrochemical products. And all that is resulting into the overall inflation pressures. Quite a lot of investors are worried about the inflation pressure resulting into maybe faster tapering as well as raising interest rate by the Fed. However, we believe that the overall price rise in regards to the oil should be stabilized in the future because of, if you look at the overall production side, clearly OPEC as well as U.S. can increase the production, but they're not doing it aggressively. If you look at the rig counts of the U.S., it's only 428 versus what we've seen the peaks of about 1,600. So I think that the demand is there and resulting into the price rise, but I think that it's the supply side is actually limited or reducing it in a sense to keep the prices high. So we don't think that this is going to last for a very long period of time. It should be able to stabilize sometime in the next year of the first half. So if that's the case, then I think we should not be too worried about the stagflation, but rather the economic growth rate coming in nicely due to the fourth industrial revolutions. And if you look at the overall productions and demand, is reasonably good with the salary and wage increases. So yes, currently in the short term, people are worried about the stagflation, but in reality, we are probably in an era of Goldilocks.
Well, those issues and several others leading to a rough month for stocks. Now with the issue of the U.S. government's debt ceiling, the prospect of a default, we have the Dow off 4% from its recent high and the S&P off around 5%. What's the story in the global markets?
Yes, if you look at the Wall Street, it was down quite significantly. The Dow was down by 300 points plus. S&P was down 1.5%. NASDAQ actually down more than 2%. Clearly, the tech shares were the main concern because of the higher 10-year Treasury yield and worried about the slowing growth, high inflation, and rising commodity prices, and also the issue about the Facebook, all resulting into the decline of the NASDAQ and overall market. I think that people are concerned about the higher inflation resulting into higher interest rate, and if that's the case, it's negative news for the NASDAQ or the growth stocks. However, though, we think that the productivity increase is happening right now. It's a short-term probably concern because there's a seasonality factors. If you look at the seasonalities, usually U.S. market tends to be weak in the month of September and October. Once those pass, we think that it should be reasonably okay. We think that the earnings are supported right now. And if the earnings growth is strong, we don't think that we should be too worried about it at the current point in time. But in the short term, though, probably until the end of the October, we think that we should be concerned about the market volatility.
Well, Korean stocks getting slammed too lately. The Kospi down to where it was roughly 7 months ago, below 3,000 points. Almost all the top 10 companies by market cap were down today, and major declines for Korean biopharmaceutical companies. Tell us about the domestic market.
Yes, as you said, the Korean equity market fell sharply today. It's all about technicality that there's a no support line, and therefore the prices are falling quite sharply. Most of the large top 10 market cap stocks were down. Kospi was down 1.12%, and Kosdaq was down 2.6%. Continuously, the foreign investors are the net seller of the market of about 600 billion, while the retail investors bought 438 billion, and domestic institutions bought 139 billion. I think there's concern about the currency movement. If you look at the Korean won, continues to weaken. It's at around 1188 level. As long as the currency continues to weaken, foreign investors not going to be coming back anytime soon, and that's the reason for the current correction. However, if you look at the overall fundamentals of Korean companies and the earnings, we think that it is very strong, and the year-on-year growth rate is one of the highest amongst the other countries. And with the weaker currency, the export companies are going to show even better earnings numbers. So all in all, we don't think that we're too worried about the market in a longer term, but in the short term, the technicalities of U.S. market as well as the currency movement is resulting into the current volatilities. And but though we think that is an opportunity to buy.
We can talk some more about those technicalities in the U.S. This week. We'll have to keep an eye on what happens in Washington with the debt ceiling and Biden's budget. In Korea, we'll see data on consumer prices, foreign exchange reserves. What's on your radar in the days ahead?
Yes, I think that we are really looking into the consumer prices rise, not just the U.S., but as Korea and all the other countries. Clearly, the energy price is quite a concern. But we think that we need to watch out for what's happening to the other consumer prices. If the continuation of the price rise happens, then the Fed will be forced to raise interest rate faster than expected. We are expecting the Fed rate hike for the first time would be sometime in 2023. But if the inflation persists, then Fed might have to do it faster. So we should be watching that carefully. And also, the Chinese market will be opening up on Thursday. It's been closed for quite a long period of time. We need to see how that happens with the Hongda Group, Evergrande issues. If the liquidity situation stabilizes, then market can recover. So we need to watch out for that.
All right, we'll do that indeed. Mr. Yu, thank you as always for sharing your insights with us. We appreciate it.
Thank you very much.